Hello and welcome to the ADM Investor Services Weekly Market Kickoff. Please note that the views and opinions expressed here today are solely those of our guests and should not be construed as the views or opinions of ADM Investor Services or Archer Daniels Midland. Today's panelists are Mark Bowman, our Senior Global Market Analyst, Mark Soderberg, our Senior Ag Market Specialist, and JP Steiner, our Associate Economist. Starting with energies, Mark Bowman, what implications do the Russia-Ukraine war have for the crude oil market?
Well, we've seen a lack of progress on the peace negotiations between Russia and Ukraine since the meetings between Trump and Putin and between Ukrainian President Zelensky and Trump and European leaders. Russia has stepped up its attacks on Ukraine, and then over the weekend, Ukraine hit a Russian fuel port in the Gulf of Finland, as well as a nuclear plant east of the border with Ukraine. As said, there's been no real progress in the peace talks. Trump has reiterated his threats of sanctions against buyers of Russian crude. At this point, China seems to be ignoring those threats, but there's still negotiations going on between the U.S. and China over a host of trade issues. And India, which had suspended buying earlier this summer as they were negotiating with the U.S., appears to have resumed their bids now that the 25% increase, bringing their total to 50% tariffs, has been imposed due to their buying of Russian crude. Now, on the other hand, we have OPEC production increasing after they lifted their quotas this year, which provides a supply cushion and perhaps a potential supply surge coming. U.S. crude stocks, the lowest level for this point in the season, at least 6 years. But they may have put in a counter-seasonal low for the year in June. They tend to bottom in mid-September. We're also running very high refinery levels near 6-year high.
All right, Mark, next question for you. How are the tariffs behind the rally in coffee prices?
So these tariffs, the U.S. put 50% tariffs on imports from Brazil, and they were enacted. And up till recently, Brazil represented about a third of U.S. consumptions. Now we've seen ICE exchange stocks fall to their lowest level since May 2024 this month, and this appears to be buyers or people taking stocks out because they want this Brazilian coffee. Brazilian stocks now only 18% of the total versus 49% a year ago. They usually kind of dominate those supplies. These tariffs now have buyers looking to Colombia and Central America. Brazil seems to be selling to Europe. Perhaps there's some reshipping from Europe to the U.S. It's also possible that the Brazilian sellers have been reluctant to commit as well with this kind of still uncertainty. The Brazilian government taking steps to subsidize producer sales into the U.S. to make up for the tariff and equalize prices with other suppliers. So needless to say, there's just a lot of confusion over where the coffee is going and what's available. Those Brazilian harvest is now 99% complete, but we may not be seeing the usual harvest pressure. And on top of that, Brazilians' production isn't as strong this year. They're in the off year of the biennial production cycle. Forecasts now running about 40 to 41 million bags versus 43 million last year. Colombia's production also slightly lower, down to 12.5 million versus 13.2 million last year. And world production off slightly, 97 versus 98.7 million bags last year. We also have Robusta prices climbing, which seems to be something going on beyond just the tariffs.
All right, thanks, Mark. Moving over to grains, Mark Soderberg. How will Friday's announcement from the EPA regarding small refinery exemptions impact soybean crush?
Well, unfortunately, I think there's still a lot of uncertainty surrounding Friday's announcements. Of the 175 requests the EPA did rule on, 63 were granted full exemption, 77 were granted partial exemptions of 50%. 28 were denied, while 7 requests were just outright determined ineligible. Total RIN exemptions granted at 5.34 billion gallons seemed a little bit high. However, those prior to 2023 have expired, meaning there's not going to be a flood of older RIN credits being dumped on the market, causing prices to crash. The uncertainty lies in the 1.39 billion gallons from 2023 and 2024 that the EPA will be trying to reallocate to larger refineries under the renewable fuel standard in 2026 and 2027, something that will likely be challenged in court by big oil companies. But if the EPA is successful, I think this will be bullish for soybean oil as prices hover just below 55 cents a pound right now. Last week, crush margins did surge 35 cents a gallon to $2.20 per bushel, and that after falling nearly 35 cents the week before. And I think the biggest reason behind last week's jump in crush margins, also largely due to surging soybean meal prices. Many end users of meal have been pretty much going hand to mouth here with their procurement strategies, and crushers do often take downtime for maintenance in this late summer timeframe, something that gearing up for the upcoming harvest. So I'm guessing these end users are caught off guard by the slowdown in production and therefore smaller inventories. Commercials have canceled a huge amount of delivery registrations of soybean oil with the exchange and indication they won't be dumping as much supply out of the marketplace via deliveries. So this is happening while the speculative traders have been busy buying soybean meal, covering up what was a sizable net record short position just a couple of weeks ago. So I would look after the slowdown in crush operations here in this late summer timeframe to expand out to record levels again here come this fall.
All right, thanks, Mark. JP, was Friday's market reaction to Powell's speech justified?
I think markets were a bit too joyful over Powell's speech on Friday. If you look at how markets are performing today, you are seeing a bit of a pullback, showing that investors are probably thinking the same thing. Powell's speech was relatively well balanced, but it has been a long time since we have heard really any sort of dovish speak out of Powell. So that essentially, when he made his comments, he opened the door for a rate cut this year. Markets took full swing over the shift in sentiment. Powell acknowledged that the Fed was in a challenging position ahead of its September meeting, as job growth has slowed while tariff-driven inflation lurks. Powell's cautious tone reflected the tricky economic dynamics that the Fed is grappling with. That's going to be a labor market that he described as showing curious signs of softness despite a low unemployment rate, and tariff-driven price increases that are just beginning to work their way through the economy. Still, Powell opened the door for a rate cut by showing more concern about a labor market slowdown. He said that the labor market's apparent stability masked an unusual underlying weakness, with both the supply of workers and demand for them declining simultaneously. Businesses are still feeling out the demand curve when it comes to customer price sensitivity, as that landscape is essentially in uncharted waters. And a lot of economists are unsure whether or not traditional economic theory is going to match reality, reinforcing the Fed's wait-and-see approach, because quite frankly, we're just not entirely sure what the end picture is going to be. Now that markets have had the weekend to digest his comments and look at the week ahead, focus is going to shift to the PCE data that we're getting at the end of the week and labor market data at the end of the month, which will certainly shape investor sentiment a little bit more than his comments last Friday regarding the amount of easing we're going to see by year end.
Hey, JP, you mentioned the PCE inflation data. How do you think that's going to shape the September Fed meeting?
Yeah, so Friday's PCE inflation data is going to be big for the Fed. It's the last major piece of economic data really before we get the August labor report. And PCE inflation, as we all know, is the Fed's preferred measure of inflation, since it includes a wider range of goods and services, and also a chain weighting index that adjusts as consumption patterns change, making it a bit more accurate measure and a more comprehensive measure of consumer behavior and prices. Core PCE serves as a policy benchmark for the Fed, since it better reflects underlying inflation pressures and is directly used in the Fed's 2% target. Now, getting away from the details, markets are expecting the Fed to cut rates at the September meeting, just given Powell opening the door. after he cautiously signaled the September rate cut, essentially saying that despite inflation concerns persisting, risk to the labor market may warrant a change in policy stance. Markets are pricing in an 83% chance that the Fed will cut rates in September. That was down from 90% on Friday. Now, in regard to the PCE data, investors will be looking to this inflation reading to confirm their suspicions, as well as for clues as to whether or not the Fed will continue to reduce rates again before year end. If core PCE is strong, then the Fed will most likely require another weak non-farm payrolls report in August to justify cutting rates at its September meeting. Core PCE is expected to rise 0.3% in July, with June's annualized reading last sitting at 2.8%. We have seen input inflation on the rise. Last week's PMI survey told us that tariffs remain a key headwind for companies when it comes to costs. Input costs rose to their or resulted in average selling prices coming to their highest reading in the past 3 years. Additionally, the most recent PPI inflation report showed a worrying uptick in price pressures in the services sector, and inflation there tends to be sticky as well. As these pressures are sorted out by market dynamics, inflation is likely to stick around throughout the fall and rise into the fall, I should say, giving the Fed reason to hold rates labor market dependent. So, I mean, in my opinion, I think Friday's PCE reading will just be another piece of the puzzle for the Fed when it comes to a rate cut in September. But if not in September, then I would expect the Fed to move to cut rates in October.
All right, thank you all. Remember, the views and opinions expressed here today on this video are solely those of our guests, speakers, and should not be construed as the views or opinions of ADM Investor Services or ADM. If you would like more information about our brokerage services, please visit admis.com. Thank you.